All right. Hello, everybody, and welcome back to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. I'm here with Renji Matthew, and today we're going to be talking about why you shouldn't send extra money to pay off your mortgage sooner. So don't send it to your mortgage company. There's going to be some better strategies and better ways to potentially help you pay off your house sooner if you want. But otherwise, this is the Wealth Building Show. We're going to give you some other insights into how you can utilize that money better to build wealth quicker and more efficiently for you and your family. Now, Renji, we've talked about it before in a podcast, but just to clarify and to make sure, you in the past have sent extra money to pay off your mortgage sooner, right?
Yeah, when we first started, when we first bought our first home, we weren't looking at real estate in a sense of passive income, stuff like that at that time. So we were big Dave Ramsey fans, and he talks about how you put, extra money into the mortgage to pay it down. So we were en route to pay off our debt or pay off our mortgage within less than 7 years, conservatively. And we were sometimes we lived off of my wife's income and my income, we put it all towards the house and retirement. And at the time we were paying double, sometimes triple the mortgage per month to pay down the house. And it it made sense at the time. The good thing was, because we did that, when we finally got into doing real estate, we had enough equity in our house that we got an equity line of credit, and that's how we got our first few rental properties. So it worked out in the long run at the end. But knowing, there was a lot of different ways we could have done that, and I think that's what we're going to talk about today. So I'm excited to talk about that.
For sure. And I think you said something that was important there. Like you said, it made sense at the time. And I think that's where a lot of people are at because we're not taught about money in school. So we don't even know that some of these other ways exist, right? We don't even know it's possible to, talk about some of the other strategies that we're going to talk about today to help you achieve the same goal, which is maybe to pay off your home quicker, but to do it in a way that's actually going to protect you more than it's actually going to give, more protection to the bank. Which how we see it, how we view it now that we understand how money works and we know what the different options are available. If you think about it logically, it doesn't make any sense why we send extra money to our mortgage company to try to pay off the home earlier, right? The reason I say that is what happens if you were to lose your job, right? Or what happens if you were to get sick? Or what happens, God forbid, if you were to pass away? An early death or an unforeseen death or even an illness is like the number one cause of foreclosures and bankruptcies in the United States. And a part of that can be contributing extra towards your mortgage. And if you're paying extra money to your mortgage, you're losing out on the savings and or growth potential that money could have had in other accounts to be able to protect you and insulate you should you die too soon, should you get sick way too soon, or should you lose your job. Right? Or if you're a business owner or investor or entrepreneur, like we talk about on this podcast, what if business slows down, or the economy slows down? What if another, March 2020 happens, another COVID comes around? If you're sending all this extra money to your mortgage, what happens then? Right? And Renji, let me ask you this question. Let's say that you have before sent extra money to your mortgage company. Maybe your mortgage amount is $1,500. But you've always just rounded up and sent them $2,000 a month because you were taught and you thought through it. You're like, hey, if I send $2,000 a month instead of $1,500, I'm going to pay my house off early, right? But what happens if one of those scenarios comes up? You get sick, maybe you or your spouse dies, too soon, unforeseen circumstances come up. If you sent extra money to your mortgage company in the past, 1 month comes up, you hit a rough spot, and you need to catch a break from the mortgage company. Will they let you go a month without making that $1,500 a month mortgage payment?
Nope.
They won't. They might let you might let you go 2 or 3 months, right? But in their eyes, what happens? You've paid down this mortgage. You have an appreciating asset. If you start missing a payment, 2, 3 payments, I don't know the exact circumstances, how soon they may look to, foreclose you on the house, but you start raising alarm bells in their system that you're a potential homeowner that's going to lose their house. And then what can they do? They can take the profit, they take the house back, and then they short sale it. They take their profit, and then they loaned out another mortgage, lend out another mortgage to somebody else that they can make money off of as well to borrow on that same house. Not only to mention, right now interest rates are higher, so in the bank's eyes, they're making way more money on mortgage rates now than they were maybe 2 or 3 years ago. So that could be another, thing that is good for banks. But banks don't always have our best interests at mind, right? Banks are a for-profit business. And so if you ever go a month without making a payment, 2 months without making a payment, 3 months without making a payment, you could potentially enter a scenario where the bank is taking back your house and you're losing all of that money that you were sending extra, right? Renji, did I miss anything? Is there anything that you wanted to add to that scenario?
Yeah, that's exactly what happens. It's foreclosures and everything like that, and like you said, it could vary depending on the state. But here in Oklahoma, yeah, if you stop payments, if you didn't pay 1 month, it sends them a red flag and they'll send you a notice. If you do it 2 months, another notice, and now you're going into pre-foreclosure. 3 months, you're in foreclosure, and like you said, it could go to a short sale or an auction or whatever, and all that equity you put into the house is gone, right? But knowing what I know now, like we did the math. If we would have put that money, extra money, into an asset that is like a secure retirement plan that we talk about, there are several different ones we've talked about, and if we would have put it into any of those, if the market conservatively did 5.5%, which we know that is really low in a 10-year period, the market could do anywhere between 8 to 10%. But
You're saying the stock
conservatively,
market, right?
yeah, stock market.
Okay. Yep.
Um,
Go ahead.
if if it would have done conservatively 5.5%, in that, I think our mortgage was 15 years at the time, and our goal was to pay it off with between 5 to 7 years. If we were putting that extra, we could have paid that off, and we would have saved, I believe it was 47,000 in interest. Right. So that's what we were focused on. It's like, okay, save money on the interest, don't pay all that interest and stuff like that. But what we missed out on, what we didn't know at the time, if we would have put that extra money into one of these tax-free secure accounts, yes, we would have paid 47,000 in interest in 15 years. But in that 15 years, we would have had a paid off house. Yes, we would have paid 47,000 in interest, but we would have had conservatively 500,000 in a tax-free retirement account. So what we missed out on, what we didn't see at the time, was $500,000 that we could have grown tax-free and access to build more wealth. Yes, we did the math to see what it would have looked like. Okay, what if we did continue to do that, and after that 5 to 7 years, then started putting money into that? It would have still grown well, but the difference between paying it off in 7 years and starting it and doing it all from the start was almost a $200,000 difference in growth in that account. So again, it's different people have different goals, but knowing what we know now and what our goals were, if I would have known about these accounts back then, that's what I would have done.
For sure. So you looked at like the opportunity cost, right? Which is analyzing and looking at both ends of the spectrum. What is the cost if I go this route and do this versus what's the cost if I go this route and do something else, right? And too many people look at the cost or the expense of a decision, but they don't look at the value, right? Too many people focus on the cost rather than the value. The rich and the wealthy know to look for the value in different things, right? If it's going to cost you $47,000 to pay your mortgage in 30 years, but you know that with that same amount of money, you can, what amount did you say? Did you say 200,000 more?
Yeah, it would have been almost 500,000
Half a
if we
million.
would have done it from the start. Yeah,
Okay.
if we would have
So too
waited
many
to
people
seven
focus
years
on
to
the,
pay it off. Yeah,
yeah. So too many people focus on the cost, the 47,000, when in return it could have returned them 500,000. Now maybe it's just lack of education and not knowing, which I think is a lot of it, and not running the numbers and knowing even how to calculate or do the numbers. But this is why we're talking about it on our podcast, right? It wouldn't make a good podcast episode if not everybody knew about it. So that's exactly what we're talking about here today, right? And now there's better ways to pay off your mortgage earlier and to do it sooner. The number one way, which I think is going to be the quickest way that we could talk about before we go into the next couple of routes, which will take a few extra minutes. But most people don't realize that your mortgage payment is due once a month. right? But the funny thing with the calendar is that there are 52 weeks in a year. Every single month has like 4.3 weeks inside of the month, right? So if there's 52 weeks in a year and most people get paid bi-weekly, but let's just say you're going to start making bi-weekly payments to your mortgage company in the same time that you get paid, there's technically 26 bi-weekly payments that you get into your bank account every year from your work, right? So if you were to make bi-weekly payments to your mortgage company, that would be a total of 13 payments every single year. I'm messing up the math. That would be 26 payments every single year, which divided by 2, if you did it every 2 weeks, would amount to 13 payments in a single year to your mortgage company, resulting in you paying 13 months of the mortgage instead of 12. I messed that verbiage up, Renji. Did that make sense, or is there a way that you can clarify it for me?
Yeah, no, it made sense. In the
Okay.
52 weeks, if you do biweekly payments, that's overall, instead of making 12 payments in a year, you're making 13 payments in a year. So you're putting more towards the mortgage.
Yeah. You're making 13 months worth of payments. So you are putting more to the
Hmm.
payment. And the thing is, by making the payments bi-weekly and because you're spreading it out over the course of 1 year, that extra one payment doesn't really affect your cash flow much. That extra one payment every single month might be an extra meal that you would have gotten, at a fast food restaurant, or maybe one extra dinner a month. But that one extra dinner a month is making one extra payment to your mortgage. And if I believe correctly, the math on it, if you made 13 months worth of mortgage payments each and every single year, that would take off like 7 years of your mortgage in the long run, right? And so that's one way to help you pay off your mortgage sooner, but without dumping all this extra money to the mortgage company that's putting you at extra liability and extra risk, right? Another way that you can help yourself achieve the goal of paying off your mortgage sooner is through mortgage protection insurance. Now, most people don't even know that this insurance exists, and most people make the mistake of thinking that mortgage protection insurance is the same as your homeowner's insurance, and it's not. They're two totally separate, different things. Your homeowner insurance protects the bank, where if something happens to your house, like a fire, tornado, we've had bad storms all across the United States the last few days. If anything like that happens to your home, it's protecting the bank, right? And protecting you, I guess, right? But what happens if you or your spouse were to pass away? That homeowner's insurance does not do you any good, right? So, Renji, break down for us what mortgage protection insurance is and how, with the right type of mortgage protection insurance, it can actually still help you achieve your goal of paying your house off 5, 10, or maybe even 15 years earlier if you wanted to.
Yeah, so there's different types of mortgage protection insurance. The simplest way is if something happens to you and you pass away, you or your spouse and you pass away, it's life insurance. So your family member, your spouse gets a chunk of money to either pay off the house or pay down a couple years worth of mortgage. That way, they're not worried because when a death happens in your family, that's the worst time to make a financial decision. The worst time. That's why you see a lot of people trying to get out of, sell or get out of their house fast because they don't want to deal with it or something. Or if a parent dies, they don't want to have to take on that mortgage or whatever, different things like that. So that's the worst time to make a decision because that's when you're gonna get rid of the house. So you're gonna ask as less as you can just to get rid of the house, right? But if you
Mm-hmm.
had a mortgage protection plan in place, now you have enough money to either pay off the house so you don't have to worry about a mortgage anymore, or enough money to fix the house up and get the right value paid to you. That way you're not getting rid of it just to get rid of it. Then there's other types of mortgage protection plans where it builds cash value in there. So again, once that person passes away, or let's say you didn't pass away, because 95%, I think it's less than 5% of mortgage protection plans pay out or term insurances pay out because you're pretty much healthy to get these plans, right? So most
Yeah.
people outlive that. So if you outlive that, now these ones that grow cash value, it pays that money back to you. Now you can put that lump sum into paying off the house too. So there's different types of like that. Then there's ones that the TFRAs we talk about, where it also grows cash value. Now you let's say you paid the house off, you live past that time period where you have to pay the house off. Now you have all this cash value building in there that you could use to buy assets, or you can keep putting money into it. Now it's a retirement account for you when you retire. But if something did happen to you, again, you have a big enough lump sum that goes to the family to be able to pay off the house also, and it all goes to them tax free. So those are the three or four different options that are available to you. Is there anything you need to add to that, Kyle? I don't know if I mentioned everything.
Yeah, no, I like it. You had mentioned something in there, and let me know if I heard this correct. Like you mentioned, in the time of something happening, like financially, like your emotion goes up, I think you said, right?
Hmm.
And then you tend to make bad financial decisions.
Yep.
When
Yeah.
your emotion
Whenever.
goes up, it's typically like
Sorry.
a seesaw scale. When your emotion goes up, your logic goes down. When your emotion goes down, your logic goes up, right? That's why it's so good to eat, like I think we mentioned this in the last podcast. Talk to another financial planner, have somebody else outside of you help you make financial decisions because their emotion, they don't have any emotion for it, right? They're all logical and helping you out. If it's your own money and you have emotion attached, your logic goes down. It's a seesaw scale. So I loved what you said about that. And then another thing, like with your mortgage, excluding right now, because rates are at the highest that they've ever been, in the last 20, 25 years. But typically, your mortgage and the loan that you get on your mortgage is some of the cheapest money you could borrow. The average credit card interest rate right now is like 21%. Mortgages right now, and they're at the highest that they've ever been, is at like 7 to 8% rates, right? Car loans are higher than mortgage rates. They're at like 9 to 10% rates. So mortgages being some of the cheapest money you could ever borrow, also being backed by an asset. So it gives you technically way more risk if you're paying extra towards that versus maybe extra towards your car. I don't see a reason why anybody should ever send extra money to the mortgage company, right? And like you mentioned, these mortgage protection insurance plans make way more sense if your goal is still to pay off your house early. And something you mentioned in there is that, yes, it is a life insurance policy because the only insurance that's ever going to pay out to you or your family if you were to ever pass away is a life insurance plan, right? And the crazy thing is the government requires car insurance to protect your car. They require home insurance to protect your home, but they don't require life insurance to protect you and your family, which is crazy because that should be the only one that's required, right? And that, as far as we see, but it's not. But it's up to you to learn about this information and or to seek out this information, right? And so a life insurance policy, for example, let's actually just break it down and how it would work. So let's say that a married couple, age 30, were to get a $300,000 mortgage for a 30-year term, right? And actually, here, let's just kind of do the math together. I think this will put it into perspective, like how it works. So I'm gonna look up a mortgage calculator for 300,000 at today's rates. This is perfect. So $300,000 at today's rates would be let's just round down and say a $2,000 monthly payment. It would be a little bit higher, but for math purposes, this is perfect. So for 30-year-olds, 30-year mortgage, $2,000 a month, right? What we would recommend in that standpoint is to get a mortgage protection life insurance policy for $300,000 for the husband and the wife that would cover them for a period of 30 years. Right? So if anything happens to the husband or to the wife, God forbid if they pass away, the mortgage is then paid off for the remaining spouse, right? But not only if they pass away, what if they get sick or if they have, terminal cancer or an illness like a heart attack, stroke, what's another one? Alzheimer's. If anything like that comes up, you may not pass, if they're 30, they may not pass away over the next 30 years. They'll be 60. Average life expectancy is 78. But what is more common or more likely, I guess, between the ages of 30 and 60 rather than death is a major heart attack, stroke, cancer, any ailment or illness like that, right? These modern day mortgage protection or life insurance policies have built in riders that allow you to use that death benefit while you're still alive. So what does that mean? If you have a heart attack in year 15, your mortgage may only be, down to the balance amount of, let's say, 180,000. You still got this $300,000 death benefit that you can tap into and help you do what? Just continue to make the monthly mortgage payments. The mortgage company doesn't care where you get your money from or how you're making your monthly mortgage payments. They just want to make sure that every single month they're getting paid their $2,000 a month, right? So if you did have a heart attack, what typically happens in that scenario? Typically, you're off of work. You might get a short-term disability from your job. If you're a business owner, you may not be able to run your business anymore, right? So you had a loss of income then. That's when this life insurance policy could come in place and actually save you from losing your house. If you're at work, you may have short-term disability. You may get laid off. You may have to take an income loss, but there's just too many variables there that lead to the potential of you losing your house, losing your biggest investment, losing your biggest expense, and having nothing to show for it, especially if you paid extra into your mortgage over the last 15 years, right? We talk about this, and the crazy thing is, most people don't expect it's ever going to happen to us, but I've known people in their 20s that have passed away too soon, that have got cancer way too soon, right? I've known people that have lived to be 90, 100, 105 years old, right? We just don't know what our life is going to look like. But the best thing you can do is lay the foundation to protect yourself financially from some of these risks that can come up, right? So we talked about just the 30-year term. And if you ever get sick or if you pass away, right, how you can use the policy then. But you mentioned one other thing, Renji. Let's say that they wanted a 30-year mortgage protection policy where at the end, if they outlive it and they're still healthy, they don't use the policy. You said they get all their money back, right?
Hmm.
So
Yep.
how does that work? What do you mean that they get all their money back? The insurance
Yeah. So
company
the
just cuts
way,
them a check for everything they paid into it?
yeah. So the way it works is, you paid in a certain amount every month into this, and after the 30 years, that cash value is paid back to you if nothing happens. Of course, this is going to cost a little bit more than the basic term that we talked about first. And something that a lot of people don't realize, especially when you're younger, the biggest cause of death other than heart attack is accidents. Right? Because you have
Yeah.
to be pretty healthy to get these active, and a lot of times people outlive them. Because I think it's more than 95% of the time they outlived them. So you just paid all that money into it for no reason, technically, right? Or it feels like that, anyways. But if you had it where you got the cash back to you at the end of that, hey, now it's like a savings account where you were putting money into it for months, every month for 30 years, you're getting all that money back. That's awesome. Now you have a huge chunk of money, like we said, to use either to pay the house off or invest into another asset or whatever it is at that point. Because you put money away for so long, you were protecting your spouse or your family from a loss if they had to deal with that if you were gone. But now at the end of that, if nothing happened to you, you're getting all that money back too. And like Kyle
Yep.
mentioned before, if and these plans come with those living benefits where if you had any type of chronic, critical, or terminal illness, you can tap into that cash value. So these kind of work like those back in the day. They had long-term and short-term disability plans. They kind of work like those without having to pay those hundreds of dollars for those plans. They're built in. Um, but yeah, and I think that's all I wanted to add to that was the accidents, because that's one of the ways that most young people pass away is car accident or whatever accident there is. But these will help with in those scenarios too.
Absolutely. And then one thing that we didn't touch on that I want to go back, we talked about the 30-year plans, right?
Mhm.
And the pessimist watching the video is like, I thought I could pay it off early. Instead of doing the 30-year plan, you can elect for like a 25 or even a 20-year plan too, where you'll get all your money back after 20 years. And guess what? When designed properly and set up properly, after 20 years, you can still have that life insurance policy that ends in year 20. And guess what? With the money that you get back, it should be really, really close to the amount that's still due on your mortgage. The insurance company gives you that money tax free. You can cut a check to your mortgage company and still pay your house off in 20 years rather than 30. But what did you do? You did it a smarter way. You did it in a way that protected yourself from all these risks that we can't predict. We don't know if or when it's ever going to happen, but you protected yourself from the worst case scenario. right? Which is exactly what insurance does. Car insurance protects you from that. Auto or homeowners insurance does that. Mortgage protection life insurance does the same exact thing. So Renji mentioned it's like a savings account, right? That's tax free. You're not exposed to market risk. Now, depending on the type of plan you set up, you may or may not be able to access the money before the 20 or the 30 years would be up. But as we've talked about before, there's other, tax-free options that we could set up instead if you didn't want the mortgage protection life insurance. But simply enough, if we're just comparing apples to apples, if you should send the extra $500 a month to your mortgage company, or if you should send the extra $500 a month to an insurance company for the mortgage protection insurance, the mortgage protection insurance makes way more sense than going to the bank, right?
Yeah, it's something that I feel like we should mention too. You're not just protecting yourself, you're protecting your loved ones that you leave behind if something happens to you, right? Because especially if you're the breadwinner at the house, like for example, for me, um, I make the income in the house, and if something happens to me, I don't want my wife have to go back to work and all that stuff. So we have all these plans in place that if anything happens to me, all our mortgages, our rental properties, everything will be paid off. Now she would have passive income where she will never have to go back to work, right? But if nothing happens to me and I live long, hey, now we have all that money coming back to us. Now we can invest into something, right?
For
And
sure.
if something happens to me where I don't die and I have some kind of chronic, critical, or terminal illness, we can again tap into these plans instead of having to take out a loan to pay for medical bills or whatever. So there's different goals. At the end of it all, you're doing anything that you do to provide for your family and to protect them. So if you don't have these plans in place and you're putting extra into the mortgage, are you really protecting them? Because if something happens to you, they're going to have to come up with money to pay that mortgage monthly. Like you said before, bank's not going to forgive your mortgage just because you had a loss in the family. You
Yeah,
still have to, they're still going to want their monthly mortgage. So if something happens to you and your spouse doesn't have the money to pay that mortgage, a couple months goes by and they're going into foreclosure, right? So having these plans, like Kyle mentioned, it protects them. And at the end of it, if you live past that, now if you go with the plans that give you the cash back or builds cash value, now you have a chunk of money you can put into it to pay the house off early. But if something happened to you, your spouse or your family that you leave behind don't have to worry about that either, because like we said before, when you have a loss in the family is the worst time to make a financial decision because you're emotionally not really stable at the time to make a financial decision.
absolutely.
Yeah, I just wanted to add that in there.
That's great. And we did actually get a really good question that I want to bring up and talk about here on the podcast. And for those of you that are maybe watching this podcast back through YouTube, we do go live on our TikToks while we're recording the YouTube. So we're filming it both ways, right? And we did get a question live that I think is actually great to mention and talk about. How do you determine which plan is best at the time of signing up? And that's a really good question because you guys on YouTube may be thinking of it too. And it really depends on your budget. Like we've talked to people or we've heard people in the past, that have sent an extra $1,000 a month to pay off their mortgage because their goal was to pay it off like within 10 to 15 years, right? Maybe some others are just sending an extra $100 a month or $200 a month. So depending on whatever your budget is would help us determine what's going to be the best plan. And typically it aligns. Like if you were to do the math and, $500 a month extra towards your mortgage would pay off your mortgage and maybe, 10 years sooner, that would probably line up with what the results would be through going through a mortgage protection insurance. So a lot of times it's based on your budget and what you can save and put into something like this to help you out, and also your health. If there's one downside, you do have to be healthy to qualify, right? Which is why this may not be a good fit for everybody, but is why you should get this while you are healthy, if you are healthy, right? Because if something comes up, the crazy thing is, even just sometimes one or two medications can be a reason that this policy, you can't get approved for it, right? So it makes a lot of sense to get it while you're young, while you're healthy. Don't delay it because we never know what's going to come up in the future with our health. And maybe if you aren't healthy enough to get it, maybe your spouse is, right? And maybe it may make more sense then for you and your spouse, if your spouse is the healthier one that could get approved, for you guys to do one of like the more accumulation focused policies where you actually build cash inside of these accounts that you can use at any time, and not just after the 20 or 30 years and just get your cash back, but it actually grows and accrues interest too. Because that'll help you build wealth while still protecting the main goal, which is, God forbid, the other spouse passes away. You can still pay off the house early, but you'll build the accumulation inside that other policy where you can still achieve the same goal. How many different plans to choose from, and what are they? So there's multiple different insurance companies that offer it. My next recommendation would be, you as a consumer, you can't just call up yourself to any one of these insurance companies and sign one up through the customer service department. That's not how they work. You do have to use an advisor to help you set it up. Plus, it's good to have an advisor on your side that knows and understands your holistic financial picture and can make a recommendation for you that's going to be best suited based on your needs and your goals. So thank you, Lisa. That was a great question.
I want to add to that too.
Absolutely.
If you just called, because you want to deal with an A-rated company too. There's so many companies out there. Because if you're not dealing with an A-rated company and they go out of business, then all that money you put into it is gone, right? So you want to talk to advisors like ourselves or someone that has experience and deal with a lot of companies. That way they can give you the best option for you depending on your goals. Because like we mentioned before, there's different companies, different plans out there. And it's not one size fits all. It's specific to you and your goals and what you're trying to do. So these plans can vary cost-wise depending on your goals. It can also vary cost-wise depending on your health. At the basic term, which is ones that are the cheapest, where they pay the biggest amounts out, that doesn't really build cash value, those you really have to be healthy. But then as you go into these accumulation type of things, you can be on more medications and stuff like that, but the cost does go up too. So again, it depends on your goals and what you're trying to accomplish. That's why it's a one-on-one conversation more so, instead of just having a general one for everybody. We just wanted to give you guys information on the different types that are out there and how they work. And if we go into details on all of them, we could be talking for days because they all have different things. So this is where it's a one-on-one conversation to see what it looks like for you yourself with your age, your health, your mortgage, depending on how much you're putting in, all of those things, where we would have a one-on-one conversation to see how that looks like.
Absolutely. And we're both licensed and represent multiple different companies. We're independent brokers, so either myself or Renji can help you if you guys want to determine, what this may look like for you, or if there's even a different route that we should go. Renji and I both offer free consultations, and you can get to that by clicking on the link in our profiles on either Instagram or TikTok. And with that, I think that's a good way to end our show. Renji, not sure if there's anything else you want to add?
The only thing I would add is, at the end of the day, it's what are you doing to protect your family if something happens? How are you providing for them? And if it's not this way, how else are you doing? And that's why we also, again, talk about passive income. Is what, like we said, if you use these cash value ones, at the end of that, at that time, you have money to now go and invest into a portfolio of whatever asset to make passive income. That way, even then, when you're gone, your family is provided for. Right. So at the end of the day, the heart of it is to protect your family from loss of having to deal with your loss, or not having you there for them anymore. Right. So emotionally and financially, you're providing for them when you're gone. So I think that's what I want to end with is, what are you doing this for?
Absolutely.
Oh,
Perfect. And can you hear me okay, Renji? Because it says trying to reconnect on my side.
I think you froze, Kyle.
Yeah. All right, so we did have a little bit of technical difficulty there at the end. For some reason, our Wi-Fi glitched out and went out for a moment. But to wrap up the show, as always, thank you guys for watching another episode of the Wealth Building for Dummies podcast. Drop us a comment below. Let us know what questions you have. Maybe what are the strategies that you have for paying off your house early. And if you found this video insightful and helpful for you, make sure to give it a like and then share it with a friend or family member that you think could benefit from some of this information as well. Thank you guys for watching the show. Thank you for subscribing, and we'll see you on the next episode. Take care.